Hello everyone, my name is Divam Sharma. I am from Green Portfolio. Today, I am going to talk about dividends. Are there any risks associated with investing in companies solely for the dividend payouts? So, dividend yields with no capital appreciation over a long term is not wise. If you are only getting 2%, 3%, 4% as dividends and you're not getting a capital appreciation, that means you're not being able to beat inflation. So you have to consistently ensure that there is a dividend yield, there is consistency of income, there is a consistency in dividend income, and there is a capital appreciation in the stock. Dividend payout policy is also usually subject to change. You have to look at the cumulative returns while investing into the stock for a long term. Dividend yields that are sustainable can only go so high, but the capital appreciation in long term can be more rewarding. The company paying out most of its earnings as dividend will not be a very good investment strategy as well. There are several PSUs like NMDC, REC that has a high dividend yield and that is above even the fixed deposit rates. But the dividends are prone to fluctuation and not a 100% certainty that the dividend is going to come in the future years as well. The past consistency will help you determine if dividends are reliable. PSU usually pays out high dividend since government has major ownership in these companies. 5.5% of total revenues come from these dividends of many of these PSU companies. Companies with very high dividend payout ratio tend to trade at lower valuation multiples usually. So you have to have a proper balance. You cannot have a dividend yield or a dividend income only and not ensure a capital appreciation in the stock. So you have to have a balance. Are low dividend paying companies bad investments? Well, this totally depends on your choice of company. There are two types of returns from a stock. The first is a passive income in the form of dividends, and the second is capital appreciation. That means you have to have both the incomes as an investor. If your company is just giving out a dividend yield of say 5 to 7% without any capital appreciation, I would say that investment is not worth it, as you can easily get 5 to 7% from investing in a fixed income security and at very minimal risk. We invest in only companies which pay high dividends and which are capable of significant capital appreciation as well and are capable of increasing the income potential for the equity shareholders over the coming years. So the dividend payout is also consistent and increasing. We would also like to talk about certain additional pointers here, which investors should look at. There is usually a misconception that small companies do not pay dividends. Well, this is not the case. Companies who have stable cash flows because of their dominant position in niche industries tend to pay out dividends. When small companies earn profits, it may reinvest in the business as they forecast growth. However, they might not have sufficient profitable projects that earn their cost of capital. Hence, they might choose to distribute the excess cash. This improves the return matrix like return on invested capital, return on equity, which the investors are interested in. Even high growth companies pay dividend. Apple used to pay dividends in 1987 all till 1995, and during this period the revenue growth was around 4x. So it's not true that only low growth companies pay dividend. Dividend payout is usually a matter of management preference. So you have to look at dividends as a holistic way. You cannot have biases that these types of companies would pay dividend while these types of companies would not pay dividends. There are exceptions and there are regular exceptions as we see across the spectrum. We hear successful wealth managers say they achieve financial freedom by getting their daily expenses taken care of with dividends. How does a retail investor do so like this? Yes, dividend yielding investments gives investors an additional income stream. You should usually have multiple income streams as an investor. If a company is paying, let's say, 4% dividend yield you will essentially be getting your entire capital back in your bank in 18 years in the form of dividends. Capital appreciation, however, is a different aspect altogether. A capital appreciation can fasten your pace of recouping the capital back in the form of growth in the capital as well as the dividend yield. The initial investment might be huge, but I would say that it is a smart way to invest since you are getting a capital appreciation as well as you are getting a regular expense being taken out in the form of dividend. Now you can use this dividend income for your regular expenses. Although the dividend payout is not consistent, it could be quarterly, it could be end of financial year, it could be end of half year. But if you look at a stable cash flow in terms of dividend, you could use it for your expenses and you could retain your capital in terms of the stock and enjoy the capital appreciation. Investors should also check the usual periodicity of the dividends, as usually dividends are paid quarterly, yearly, and annually. This can help you manage your cash flows better. Is investing in dividend paying companies a do-it-yourself thing, or an expert lens is needed to be taken for these investments? See, only looking at dividend yield as a screener parameter is not enough. As we learned that you have to have growing income, consistency of income, good dividend payout policy, and non-one-time nature of dividend to ensure that your investment as a dividend yield investment is successful. You have to look at a lot of parameters while investing into stocks. You should also be continuously tracking these stocks to ensure that the company's income is intact and the company's payout policy is intact, to ensure that the dividend yield is consistent while you also beat inflation with the capital appreciation. You have to go through a detailed research. How did you identify the stock in this small case? So we look for a company that has been consistently providing dividends and has opportunity for capital appreciation. Through screeners, we usually look at certain parameters like dividend yields, like historical trending earnings growth, like debt to equity, etc. And then we do a deep dive into these companies to understand how is the company doing and how is the company going to grow its earnings per share, and how is the company going to maintain the dividend payout ratio consistently over the coming years. Then we club the philosophy of investing in high quality growth stocks that are available with the reasonable valuations. The company should have a low debt on the balance sheet. The management should have a good track record in terms of delivering success in the company. So there are a lot of factors that we look at while selecting these stocks. Not to forget that this research is a continuous effort. We continuously evaluate the company's performance, track them, track the growth prospects to ensure that the earnings in terms of dividend yield is consistent, while the capital appreciation should also happen. Few companies have already announced dividends this season. What is the overall sentiment you gathered from the payout? What does it indicate about the upcoming announcements? Well, there has been some disruptions in terms of business revenues and profitability being impacted. As we all know that there are macro headwinds across the globe. So what is very good is that some companies are going in for a capex cycle. Some companies have declared lower dividends while they have maintained their payout ratio. So as we know that because of the macro factors, some companies have reported slightly lower numbers than their previous quarters. So the dividend payout ratio is intact, but the dividend payout has slightly fallen because the EPS has fallen. The dividend yield has gone very lucrative right now in terms of 4.9% dividend yields currently. Now, if you look at even the fixed deposit rates, they are offering somewhere around 6 to 6.5% dividend income, whereas the dividend yield of this portfolio is 4.9%. So you are almost getting equivalent to a fixed deposit rate, while the valuations have gone so comfortable that you are sure to get a very high capital appreciation over the coming years. As fundamentals improve, the dividend income from the portfolio will also improve. Now remember that we are going to grow as a GDP at over 7% in 8% over the coming years. Now, if the company grows, the GDP grows, the dividend payout will also grow. So if you are entering at these levels, your dividend yield as a percentage of your investment value is going to be significantly higher over the coming years. As interest rates start falling, these dividend yield stocks tend to become more attractive as they're already giving a high dividend payout, and the dividend yield is also going to increase as a percentage of your investment. So when the interest rate starts falling, the dividend stocks get more attractive and there is a higher investor interest because the interest income from fixed deposits start falling while the earnings of companies start increasing. So this is a good time to invest into these stocks and to invest into the small case. Thank you for giving me this opportunity to speak about dividends.